What if ignoring these 14 lessons from Warren Buffett could cost you everything? Even the Oracle of Omaha, with a net worth of over $100 billion, has made mistakes that wiped out millions. This video uncovers the most critical investing errors Buffett learned the hard way. Mastering these lessons could be the difference between building your fortune or watching it vanish. Stick around to learn how to sidestep these costly traps and turn Buffett's missteps into your ultimate advantage. Warren Buffett famously said, "Risk comes from not knowing what you're doing." Yet many investors jump into stocks based on trends or tips without fully understanding the businesses they're investing in. This lack of preparation often leads to losses. Buffett's strategy revolves around thorough research. For instance, before investing in IBM, he spent years studying the company's reports and market position. This detailed understanding enabled him to make informed decisions. Skipping research can have costly consequences. Take the AI stock craze in 2023. Many rushed in without understanding the underlying technology, leading to significant losses when the hype faded. Buffett's advice reminds us to dig deep. The more you learn, the more you earn. Researching a company's fundamentals and long-term prospects isn't optional. It's the bedrock of successful investing. Trying to time the market is a common mistake. Buffett's stance is clear. We've never timed anything. Predicting market highs and lows is nearly impossible and often leads to poor decisions. Instead of guessing, Buffett focuses on identifying quality companies and holding them for the long term. During the 2008 financial crisis, while others panicked and sold at low prices, Buffett invested in undervalued companies like Goldman Sachs. His confidence in their intrinsic value proved fruitful as markets recovered. This approach underscores the importance of patience over impulsive reactions to volatility. Market timing often results in buying high and selling low. Buffett advises, "The stock market is designed to transfer money from the active to the patient. Focus on long-term value and avoid reacting to short-term market swings. Steady, informed investing always beats chasing trends or reacting emotionally." Warren Buffett advises, "Diversification is protection against ignorance." It makes very little sense for those who know what they're doing. While diversification reduces risk, overdoing it can dilute returns. Buffett emphasizes focusing on a few exceptional businesses rather than spreading investments across too many stocks. For instance, his concentrated bets on Apple and Bank of America highlight the advantages of focused investing. Apple, one of Berkshire Hathaway's largest holdings, exemplifies how Buffett maximized gains by trusting in its long-term value. Excessive diversification, on the other hand, often leads to holding mediocre businesses, limiting potential returns. Buffett's approach prioritizes investments in companies with solid fundamentals and strong competitive advantages. He reminds us, wide diversification is only required when investors do not understand what they are doing. In today's market, a few well-researched, high-quality investments often outperform portfolios spread too thinly. Buffett warns against chasing high-growth companies without assessing their fundamentals. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, he explains. Growth can be enticing, but without a strong foundation, it's often unsustainable. A notable example is Buffett's investment in Kraft Heinz, where overly optimistic growth projections led to a costly write-down in 2019. Many investors make similar mistakes, paying premiums for companies with high growth potential but weak fundamentals. This was evident during speculative surges like the 2021 tech bubble, which left many stocks floundering when hype faded. The key takeaway is to prioritize genuine growth over market trends. Buffett evaluates cash flow, profitability, and competitive advantages, avoiding speculative traps. As he says, the market is there to serve you, not to instruct you. Staying grounded and focusing on sustainable investments helps avoid the pitfalls of high-growth illusions, paving the way for lasting success. We tend to help you improve your financial health, and in return, you can hit the like button below to appreciate our work. It means a lot to us. Now, let's get back to the topic. Following the crowd often leads to financial missteps. The dot-com bubble of the late 1990s is a prime example, where investors flocked to profitless tech stocks, inflating prices unsustainably. Warren Buffett, however, avoided the frenzy, sticking to solid, profitable businesses. When the bubble burst, many suffered massive losses, but Buffett's discipline shielded him. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." Herd mentality drives markets to extremes, creating overpriced assets in booms and undervalued ones in busts. Today's hype around meme stocks and cryptocurrencies echoes similar risks. Buffett's focus on fundamentally sound companies like Coca-Cola and American Express, even when they weren't trendy, highlights the value of independent thinking. Emotional investing is a common pitfall. Markets are volatile, and sudden movements often trigger panic or greed. Warren Buffett emphasizes the importance of a calm approach. The most important quality for an investor is temperament, not intellect. During the COVID-19 crash, many panic sold their holdings, only to see markets recover swiftly. Buffett's strategy of holding stocks long-term proved its worth. He reminds investors, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Staying focused on long-term goals and ignoring short-term market noise ensures better decisions. Emotional discipline, paired with a clear strategy, prevents temporary fluctuations from derailing wealth creation. Chasing trends often leads to costly mistakes, as illustrated during the dot-com bubble of the late 1990s. While many investors chased overvalued tech stocks with no profitability, Warren Buffett avoided the hype, focusing instead on businesses with strong fundamentals. When the bubble burst, it wiped out billions in value, but Buffett's disciplined approach safeguarded his portfolio. He reminds us, the dumbest reason in the world to buy a stock is because it's going up. This advice remains relevant today, with the rise of meme stocks and speculative cryptocurrency booms. Such trends may promise quick gains, but often lack solid business foundations. Buffett's investments in companies like Apple and Coca-Cola show his focus on sustainability over speculation. Avoiding FOMO and sticking to proven companies with long-term value is key. Reinvesting profits is a cornerstone of Buffett's strategy. "My wealth has come from a combination of living in America, some lucky genes, and compound interest," he said. By reinvesting returns, he harnessed the magic of compounding to grow his wealth exponentially. Many investors, however, fall into the trap of spending their profits instead of reinvesting them. Instead of using dividends or gains to purchase additional shares or diversify their portfolios, they spend the earnings, missing out on significant long-term growth. Buffett's approach with Berkshire Hathaway exemplifies the power of reinvestment. By channeling earnings into new investments or expanding existing businesses, he created a compounding effect that accelerated wealth creation. His advice is simple: do not save what is left after spending, but spend what is left after saving. Warren Buffett often jokes, "I started investing at 11. I was wasting my life up until then." While humorous, this statement highlights the power of compounding and the importance of starting early. The earlier you begin, the longer your investments have to grow. For example, starting to invest $5,000 annually at age 20 with a 7% annual return can grow to over $1 million by age 60. Delaying by just 10 years reduces that amount by nearly half. Buffett's fortune was built over decades, demonstrating the value of time in the market. Starting early also helps weather market cycles and recover from downturns. If you feel you've started late, remember his advice. The best time to plant a tree was 20 years ago. The second best time is now. Frequent trading is a common pitfall, often driven by short-term excitement. Warren Buffett advises against it, pointing out that frequent buying and selling increases costs like brokerage fees and taxes, which can erode overall returns. Every trade comes with costs, and over time, these add up significantly. Moreover, frequent trading often leads to emotional decisions, such as buying high and selling low, which undermines disciplined investing. Buffett's success lies in his buy and hold philosophy, exemplified by his decades-long investments in Coca-Cola and American Express. By resisting the urge to trade frequently, you minimize costs and maximize growth. His mantra is simple: time is the friend of the wonderful business, the enemy of the mediocre. Warren Buffett's warning, "Leverage is the only way a smart person can go broke," highlights the risks of excessive debt. Leverage, borrowing money to amplify returns, can turn small losses into financial disasters. The 2008 financial crisis underscored this danger as over-leveraged institutions faced massive failures. Buffett avoids leverage, focusing on businesses with strong fundamentals and steady cash flow. His investments in companies like Coca-Cola and See's Candies showcase his preference for stability over risk. His advice is clear: if you're smart, you don't need leverage. If you're dumb, it will ruin you. Avoid relying on borrowed money and instead build wealth with sound investments. Fear of missing out drives many investors to make impulsive decisions, especially during market highs or viral stock trends. Buffett acknowledges his biggest regrets are missed opportunities, saying, "The biggest mistakes are the ones that don't show up. They're the mistakes of omission rather than commission." Chasing trends can lead to overpaying for stocks or investing in overhyped markets. During the dot-com bubble, Buffett avoided speculative tech stocks, focusing instead on companies with proven track records. His philosophy remains: opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. To combat FOMO, stick to a well-researched investment strategy. Let fundamentals and long-term goals drive your decisions rather than market noise. Warren Buffett stresses the importance of staying within your circle of competence. "I can only should expect to make money in things that I understand," he says. This means focusing on businesses you know well and can predict long-term. For example, Buffett's investment in Coca-Cola reflects his understanding of its global appeal and consistent cash flow. Conversely, he avoided early tech stocks, admitting he didn't fully grasp their business models. Venturing into unfamiliar sectors risks costly mistakes. As Buffett advises, you only have to be able to evaluate companies within your circle of competence. If you don't understand how a business operates, it's best to steer clear. Overlooking global and economic trends can lead to missed opportunities. Buffett's investment in BYD, a Chinese electric vehicle company, highlights his ability to recognize global shifts towards sustainability and renewable energy. Similarly, during the 2008 financial crisis, he invested in companies like Goldman Sachs while others panicked, demonstrating his focus on long-term trends. Ignoring indicators like inflation or market dynamics can erode returns. Staying informed helps you align investments with future growth opportunities. Today, we uncovered key investment mistakes even the best can make. Recognizing these pitfalls is your first step toward a more secure financial future. Each mistake carries a lesson. Knowing what to avoid is as vital as knowing what to pursue. Stick to your circle of competence, resist market timing and herd mentality, and focus on long-term value over short-lived trends. When mistakes happen, don't dwell. Analyze, adapt, and move forward with newfound insight. Patience and calculated inaction often prove invaluable in volatile markets. Let's commit to making informed, independent decisions and growing together as thoughtful investors. Share your experiences or questions below, and if this video was helpful, like, subscribe, and hit the notification bell for more insights to sharpen your investment journey. If you found this video helpful, you would definitely love Warren Buffett's simple investment strategy to turn $10,000 into millions. Click on the video on your screen to watch. Thank you for watching, and we'll see you in the next video.